Imagine streaming Wall Street grade prices to 104 blockchains while your token coils inside a textbook falling wedge, just cents above capitulation. That's exactly where Pyth Network finds itself today. June's dashboard shouts about a $1.67 trillion trading month, entropy requests exploding 23%, and 583 active integrations. Yet the chart lets anyone scoop Pyth around 10 cents. In the next minutes, we will link those fundamentals to a 5-stage take-profit roadmap that stretches toward $1 plus, lay out the invalidation line, and show how tokenized stocks are fueling fresh Oracle demand. If you have ever wanted to front-run institutions as they migrate equities on-chain, grab a coffee, turn up the volume, and stay till the very end because the math we are about to uncover makes today's valuation look almost surreal. Before the hype machine spins, open the momentum overview with me. It reads like a progress bar stuck on upgrade. Exactly 125 data providers now pump 1,645 price feeds into the network. Monthly traded volume just advanced 5.35%, landing at $1.67 trillion, more than Coinbase handled in an entire quarter back in 2023. Connected blockchains? 104 and climbing. Entropy requests exploded 23% to 5.99 million, showing devs are coding, not merely tweeting. And integration partners rose to 583. The lone negative print is total value secured, down 2.31% to 16.2 billion, which likely reflects capital rotating into newer pools rather than fleeing. Stack those numbers together, and you get an organism growing wider, faster, and smarter every single month. On July 2nd, Pyth dropped a thread that cut through the noise. Tokenized stocks are redefining how TradFi enters the on-chain world. The value prop is obvious. Stocks that trade 24/7 need millisecond-fast institution-grade pricing, otherwise they are just casino chips. Pyth already fuels synthetic equity markets on Helix, Mass.Money, Naviexonic, and JSphere. Kamino Finance routes its XStock swaps through Pyth's Express Relay, guaranteeing Solana traders the best price without leaving chain. And beyond single names, fresh feeds now cover the top 100 ETFs, from growth monsters to sleepy dividend trackers, opening the door to fully collateralized index tokens across 100-plus chains. In practice, every time someone grabs a tokenized Tesla stub, an Oracle call fires, fees accrue, and Pyth demand inches higher. Dominance numbers confirm the narrative reach. Pyth Address Market Panel reads like a scoreboard: 99% of price feeds on Aptos, 94% on Solana, 93% on Sui. Those shares slipped only a hair last month, not through competitive loss, but because the pie itself expanded. The multi-chain mosaic on the analytics site shows fresh logos almost weekly. ApeChain, Barachain, LayerN, Tyco, even zkFair. A companion bar chart tracks the climb from 75 supported chains last year to well above 100 today. Each new chain births native apps that crave latency-free market data, and every app becomes another micro-sync for Pyth incentives. Oracle business might sound unglamorous, yet it scales like software. Once the infrastructure exists, integration is mostly JSON calls and Discord handshakes, while revenue streams to the treasury. Now, liquidity, the lifeblood of any crypto thesis. June's recap pins total value secured at $16.2 billion, a gentle exhale after May's burst, while monthly volume rockets to 89.7 billion, up 8.5%. The adjacent pie is blunt. Derivatives rake in 87.2 billion, spot decentralized exchanges scrape 2.5. Pyth core users are therefore perps desks refreshing quotes every few milliseconds and happily paying for each ping. Zoom out to the stacked total value secured chart and you'll notice Solana still tops the stack, but Ethereum, Optimism, Blast, and 40-plus newcomers tighten the spread month by month. Liquidity spawns tighter spreads lure more arbitrage, and elevated arbitrage taxes every transaction with an oracle fee. In other words, growth is feeding on itself, and the meter keeps ticking in Pyth favor. Application growth seals the network effect. The integrations chart climbs like a staircase from 390 last July to nearly 600 today. Solana still leads, yet Arbitrum, Blast, and Sui also angle sharply north, while the other chains category rises fastest of all. Every colored node on that graphic represents builders who now rely on Pyth randomness, price, or volatility data. Unplug the feed and their protocol bricks instantly. That sticky dependence converts into a recurring revenue stream once usage flips from testnet to mainnet, compounding quietly over time. The takeaway is simple. The more things that break without Pyth, the stronger, deeper defensive moat around the token. Now, let's dissect the 3-day chart on screen. A grinding downtrend began in March 2024 and imposed a ceiling price revisited last December near 55 cents. Within that channel, sellers carved a broad descending wedge that snapped in April but stalled at the 0.236 Fibonacci line at 19 cents. The pullback formed a tighter falling wedge from May 10th to late June. Last week, price broke upward, and today's candle is testing the breakout zone around 10 cents. Heikin-Ashi RSI indicator has flicked above oversold, while the visible range volume profile shows thick demand between 9 and 16 cents, creating a liquidity floor and wall. My roadmap plots 5 objectives: 26 cents at the Fib trend line cross, 37 cents at the 618 retrace, 55 cents at the full extension and December 2024 high, 85 cents at the golden 1.618 extension, and finally $1.30 at the glorious 2.618. A weekly close under 8 cents voids the trading structure, not for holders and believers. Once target 1 lands, I raise the stop to entry, then trail it behind each subsequent trim, letting the market finance patience. Executed cleanly, the sequence offers roughly 6-to-1 risk-reward ratio while paying me 5 times on the way up. Volume popped on breakout candles and faded during pauses. An accumulation fingerprint. Both wedges share an apex mid-July, so bears are nearly out of time. Reclaiming the 236 retracement at 20 cents could happen within weeks, after which liquidity thins fast. From there, each oracle call and tokenized-stock swap adds pressure to a shallow book. Risk management matters more than moon math. I'm allocating 5% of my portfolio for this swing, knowing the weekly invalidation sits just below. If Pyth follows the roadmap, my trailing stop ratchets at every filled target. The mindset is detached optimism. Celebrate probabilities, ignore dopamine tweets, respect math above memes, and breathe deeply. Remember, opportunities in crypto are infinite. Deploy capital only where edge decisively outweighs stubborn personal ego. We have journeyed from big-picture metrics to candle-level tactics, data feed scaling, tokenized equities igniting demand, chain coverage widening, and the chart finally waking up. If the wedge retest holds, 19 cents is the opening milestone, and real-time stock quotes on-chain become more than a headline. That shift will not wait for retail. It is already happening. Trading it successfully demands low friction. I'm using MEXC because it lists Pyth Spot and perps with some of the lowest fees around, plus up to $8,000 in starter rewards through my pinned link in the first comment below. Deposit 100 USDT, run a quick round-trip trade, and fee vouchers, futures credits, even a short-term 600% APR vault unlock automatically. Consider it house money for your first swing. If the video added value, punch the like button, subscribe, and ring the bell so the algorithm keeps us connected. Tell me in the comments which of the 5 targets you think will hit first. I read and reply them all. And for deeper Oracle Alpha, my earlier Pyth episode and a comparison with Chainlink are queued on your end screen. Stay curious, stay disciplined, and I'll catch you tomorrow in the next chapter. Until then, may your stops be tight, your coffee strong, and your conviction even stronger. Forward ever, Pyth believers.